started.
Alright, so this is what I call the kitchen sink unit. Normally I would have done this earlier in the semester, but the semester being what it is, that didn't quite happen the way that I would have preferred. So I'm doing it right now. And what I do in this is I go through all the different graphs together and show you how it is they operate and interoperate with each other. Alright, so we're going to start with the big one, which is the king graph, right? Aggregate supply, aggregate demand. And this is all review. We've gone over a lot of this stuff individually at some point or another. But what I want to do is go through them all together at this point, right? Again, this is review. And if you want further review stuff, there is a packet that I linked to a long time ago. I'm going to send something out again about that for you to be able to look at. It's a review packet that has all the graphs and all the equations and all that stuff. It's actually 4 different review packets in one, right? I gave you 3 different ones. They all cover a lot of the same territory, but in slightly different ways, so you can look at that. And then the 4th packet within the larger combined packet is nothing more than definitions. All right, but let's look at the king graph, right? Aggregate supply, aggregate demand. And let's see if I can find a decent marker that's not crapping out on me. Much better. All right, aggregate supply, aggregate demand graph. Now what we have here on the x-axis is real GDP, right, which is going to be a real gross domestic product. Remember, the gross domestic product is the value of all goods and services that we produce as an economy. Okay, so it's a dollar figure, but it is a dollar figure of the value of what it is that we produce. And now the real part, remember, that means that we have adjusted for inflation. Okay, this is contrasting with nominal. Nominal GDP is where we're talking about the value of the goods and services produced in that year, but in that year's dollars. When we're using real GDP, we're adjusting GDP for inflation, right? And the reason we need to do that is only then can we get an accurate comparison of one year's GDP to another one. If the dollar figures, the value of the dollar has changed between 2 different years, and we're using that year's dollars, we're not getting an accurate comparison of GDP. We have to use consistent year dollars, right, that have been adjusted for inflation. So we got real GDP down here. So this is a value of what it is that we produce. Okay, remember with the gross domestic product, there are rules for what is included and not included. So it has to be produced within the country. It doesn't matter who is producing it. It needs to be a new product, not used. Right, it has to be a final good, not intermediary that is put into the production of something else, etc., etc. All right, so this is output, right? So a lot of times we'll just call this output, right? This is price level, okay? So it is the price levels that we are experiencing in the economy. You could measure it by different things. For example, CPI, Consumer Price Index, would be a measurement of price levels within the economy. Okay, and really this is just a glorified supply and demand graph. Okay, so just like a supply and demand graph, you have demand, you have supply, quantity, price, and that's all this is. But so the output or the supply and demand for one thing, we're talking about the supply and demand for everything within the economy. Okay, so we're talking about everything that we're producing. Now we're talking about the price levels for everything, except just 1 or 2 things. We're talking about the demand for everything in the economy, and we're talking about the supply of everything in the economy, the production. Okay. So aggregate demand is the equation, I remember this, is C plus IG plus G plus XN. Okay, where the C is consumption, so consumer spending. Anytime you go off and you buy goods and services, you fall under this. You got the IG, which is a business investment. Okay, technically it stands for gross private investment. Okay. Think of this as business spending. Remember, when businesses spend money on stuff, when they buy things, they are investing in capital. Okay, we refer to this business spending as investment because from the business's perspective, when they buy something, they're investing in it because they want whatever it is that they're buying, or let's say they're building a factory or something like that, they want to produce a positive return. They wanted to give more money back, right, produce more money for the company than what it is that they are spending on it. So they're not just blowing their money, right? It is an investment from their perspective. Okay, so gross private investment. You got the big G, which is government spending, government of any level. And then you got net exports, which is exports minus imports. So exports count in favor of GDP and imports count against GDP, okay? So we take all of our spending and we divide it in these four very broad categories: consumer spending, business investment, government spending, net exports, and then it gives us the total spending in the economy, which is aggregate demand. Okay, and this is a way that we can measure GDP, right? This is also a measurement of GDP because we can figure out how much we're producing in the economy by looking at what it is that people are spending, right? So if people are spending $10 on goods and services, that means there were $10 of goods and services that got produced, right? And so that is GDP, okay? So this is the demand for everything. This is the supply for everything, SRAS, a short-run aggregate supply. So we're talking about the production of everything in the economy, okay? And as we see, when price levels go up, businesses want to be able to produce more, right? When price levels go down, businesses want to produce less, okay? And when price levels are lower, what do consumers want to do? They want to spend more, right? Price levels are higher, they want to spend less. The quantity aggregate demanded is going to be lower. So just like what you would see in a normal supply demand graph, okay? So we have short-run aggregate supply and we have long-run aggregate supply. And the reason that we have the two, short-run and long-run, is in the short run, price levels matter to production decisions, okay? In the short run, they matter, right? In the short run, as price levels rise, producers want to produce more, okay? In the short run, when price levels are lower, producers want to produce less because of deflation, and they're not going to make as much money, okay? In the long run, though, we have this vertical line. In the long run, price levels don't matter. The value of the money doesn't matter. It doesn't matter what's happening to inflation, deflation. In the long run, the economy wants to be at full employment output, okay? Where we see this intersection here on the x-axis, that is full employment output. That indicates that when the economy is running at full employment, which is when the economy doesn't have any cyclical unemployment happening, we're going to be at this level of GDP, okay? So let's say that when all we have is a frictional unemployment and structural unemployment, you don't have any cyclical, all right, the economy is producing at, let's say, $20 trillion a year, all right? So full employment output would be $20 trillion a year, okay? This is where the economy wants to be. It's on long-run equilibrium. This is where we'll try to adjust to, okay? We could be over here, right, somewhere on the right side of it, which typically means we're experiencing inflation. We could be over here to the left of full employment output, which means that we're probably experiencing a recession, okay? But we want to be at that long-run equilibrium, all right? Good so far? No, we could have wound up having a situation like a recession, and what happens in a recession? It's not a rhetorical question. What happens during a recession?
There's less money to spend.
Well, it's not so much that there's less money to spend, though, kind of, sort of, but...
Less jobs.
Unemployment goes up.
Fewer jobs available, production falls, right? What happens to consumer spending?
Goes down.
Yeah, consumer spending drops. What happens? Stupid red marker. Bang. Consumer spending goes down. What happens to business investment?
Goes down.
It goes down. So what's going to happen to aggregate demand?
Gonna go down.
It's going to go down, which means it'll shift which direction?
Left.
To the left. Okay, so we labeled the first one 81, the new line that has shifted left 82, right? That should be your notation, 81, 82. We're going to dot some lines out. So you can see what the effects are. Okay, so output is decreased. If output is decreased, what has happened to the unemployment rate?
Going up.
It's going up, right? Output is falling, that means we're not producing as much stuff, which means you don't need as many workers, so unemployment rate is rising. And we see price levels have fallen. When price levels fall, what do we call that? Starts with a D.
Deflation.
Deflation, okay? So price levels are falling, deflation, unemployment is going up, all right? Now, you remember that if we're going to be a classical economist and we take no policy action, right? No policy action, no fiscal policy, no monetary policy, What do we expect to change up here?
Nothing.
It'll eventually go back to the normal.
It'll eventually go back to normal, but how will it go back to normal? What's going to move?
Unemployment will have to go up because they're accepting the.
Okay, unemployment gets bad enough. Right. Well, let's look at the problem here first of all. When we have the deflation that's happening, okay, if you're an employer, is this good or bad for you? Deflation.
Bad.
It's bad, right? Because deflation means what has happened to the value of the money?
Goes
Yeah.
down.
No.
No, it goes up.
It's going up.
Yeah, go up.
Right? Prices are falling, which means the money is becoming more valuable than what it was before. Okay? Lower prices means that your money goes further than what it did before, which means that it has more buying power. The money is becoming more valuable. Okay? Now, this is a problem if you're an employer because you have to pay wages to your employees. You got to pay for stuff to your suppliers. Okay, this is where we say that wages and prices are sticky in the short run. All right, which means they don't adjust well, especially in the downward direction. Okay, so let's say that before the recession, I was paying my workers $10 an hour. After the recession has hit, I'm still paying them $10 an hour. The nominal wages have stayed the same. All right, the number of dollars I'm paying them is the same, $10 an hour. But because of the deflation, what is happening to the value of that $10?
It's going up.
It's going up. So effectively, I'm paying them
Double.
more. Okay, nominal wages stayed the same, but real wages went up. See the problem?
Yes.
So if I'm an employer, what do I want to do?
Pay less.
I want to pay them less. I want to cut the nominal wages. But in the short run, it's difficult for me to do that because what problems could I have?
People not wanting those low wages.
Okay, nobody wants to see the number go down their paycheck. What's another problem?
Contracts?
Okay, lots of times there are contracts that people sign with employers, right, that specify a certain number of dollars going to get paid. Can I just break a contract if I'm the employer? No. Right, I can't suddenly pay them less, right? Maybe I've got a labor union and I've got an agreement with them, right? Maybe there's a minimum wage and legally I can't go below that line, right? So for various reasons, it can be difficult for me to lower wages in the short run. And my suppliers, I usually have contracts with them agreeing to pay a certain price. I can't break those either. So it's difficult for me to lower wages in the short run, so what do I do instead? I fire them. Right? If I can't pay my workers less money, then I'll simply have fewer workers and paying more money, right? So I start firing people. So unemployment gets even worse, which means that consumption can go down even more, and aggregate demand can go down even more also, and that's bad, right? But eventually, prices and wages become flexible, okay? They'll start to become flexible because eventually contracts expire and I can renegotiate. Okay, and if unemployment is getting bad enough, who now has leverage in the discussion?
The employer?
The employer does, right? The workers I currently have don't want to become unemployed. The workers who are unemployed are willing to accept lower wages so they can have a job. So I'm able to start lowering the wages that I'm paying my employees. I can start lowering the prices I'm paying my suppliers. And then I'm making more profit. So what will happen to my production?
It'll go up.
It'll increase, which will be SRAS. It will shift to the
Right.
right. So in the long run, as wages and prices become more flexible, SRAS will shift to the right. We'll be back at long run equilibrium again. We'll experience a little bit more deflation, but we'll be back at full employment output. Okay? So we're seeing that in the long run, it doesn't matter what the value of the money is, we're going to be back here, right? The economy will adjust to whatever the value of the money is going to be, if it's inflation or deflation. Okay? Now remember, this is what classical economists are going to say. If we take no policy action, okay? So if you see a question on the test that's going to be about, oh, well, what if we don't take any policy action, there's no fiscal, no monetary, what's going to wind up happening? What you expect to shift is going to be SRAS, right? That's what you expect to move, okay? If we do take policy action, though, Remember, the whole Keynesian idea is maybe in the long run, things will eventually shift back to normal, but in the long run, we're all dead. So we should do something right now, okay? So we want to take some sort of policy action, these guys say, right? Not the classical economists, the Keynesian types, okay? And policy action is focused on demand. It's focused on aggregate demand. Instead of waiting for SRAS to shift right, we're going to take aggregate demand and get it to shift to the right, okay? So they look at it as being a spending problem. People are spending too little, so what do we need to get them to do?
Spend more.
Spend more. All right, so we can take policy action, do that. We do fiscal policy action, or we can do monetary policy action. Okay. So if we're doing fiscal policy, who does fiscal policy? The government does, right? Distinguish this. Fiscal policy is done by the government. And what are the two tools of fiscal policy? Taxing and spending. All right, taxes and spending are the two tools of fiscal policy. And it's done by the government. Okay, the government is the one that does fiscal policy. They use taxing and spending. Okay. Then you have monetary policy. And who does monetary policy? Not the government, but the Federal Reserve. Okay, the Federal Reserve in the US, or just more generally the central bank. Okay, the central bank is what exercises monetary policy. In the US, that's the Fed. Okay, the Federal Reserve. Okay, fiscal policy is government, monetary policy is the Fed. Okay, or your central bank. And the tools it uses are the discount rate, or at least what College Board wants you to use. Reserve requirement. I got space. And open market operations. All right, those are the three tools of monetary policy. And so it can use these three tools to make the money supply bigger or smaller. Okay. Now over here, if we're in a recession, people are spending too little, we want them to spend more. So when we're looking at fiscal policy, okay, what can the government do to spending to get people to spend more? What will it do to its own spending?
They could raise their own spending?
Yeah, raise their own spending. So increase government spending, big G, all right? The idea there is that when the government pays people to do stuff, right, that's GDP itself, but not only that, now people have money and they're gonna spend a chunk of that money, right? Remember the whole spending multiplier stuff? Yeah, we'll come back to that, okay? So you pay people to spend, right? You pay people to do something or other, it doesn't matter what, right? Now they've got money, they're gonna spend that money, and then people have that money, it'll get spent again, right? You have yourself a multiplier effect, all right? So you can raise government spending and or you can lower taxes, okay? If you lower taxes, then people have more money to spend and they're gonna go off and spend it, right? The tax multiplier concept. Right? So this is expansionary fiscal policy, right? The economy is contracting, what we want to do is expand. So we're going to go against the business cycle, right? Do expansionary fiscal policy, more government spending, and lower taxes. Now over here on the monetary policy side, right? Over here on the monetary policy side, the government will try, or excuse me, not the government, but the Federal Reserve, the central bank, will try to encourage more spending. And the way we'll do this is by manipulating interest rates, okay? Because interest rates will influence what it is that people do. So this is where the money market graph comes into play. So the money market graph is a supply and demand graph. Like all of our graphs, it's just a supply and demand graph. Okay, and what's the supply and demand of is money within the economy. Okay, so the x-axis is the quantity of money within the economy. Okay, the y-axis, that lowercase I, is nominal interest rates. Okay, so nominal interest rate, this is the rate at which you save money in a savings account, or the interest rate you get when you take out a loan. Okay, it's not the real interest rate. Remember, that's adjusted for inflation. This is the nominal interest rate, represented by lowercase I. Okay, don't use uppercase because that indicates investment. Lowercase I is nominal interest rate. Okay, so you have the demand for money in the economy, which is downward sloping, and then you have the vertical line, which is money supply. All right, sometimes you might put quantity there. Right, the reason that the demand for money is downward sloping is that as interest rates fall, right, you see lower interest rates, right, there's a bigger demand for money within the economy. The quantity demanded for money in the economy picks up, okay? That's because when interest rates fall, what do people want to do? Spend or save? Spend, right? Now, lower interest rates, you don't get as much money for saving it, so therefore you're incentivized to spend it. Right? Basically, the opportunity cost for spending your money is lower because you're not losing as much additional money you could have gotten by saving. Okay? Now, hold on. And then when interest rates are higher, okay, what you see instead is that the quantity demanded for money decreases because at higher interest rates, people are now more likely to save instead of spend. Okay, what's the question?
What does the Q and QM mean again?
QM is the quantity of money within the economy. The Q is just marking where it is on the x-axis currently. Okay?
So there's no definition for Q.
Nah.
Okay.
Just quantity. All right, and then the money supply curve is a vertical line because the Federal Reserve has monopoly control over the money supply at any given period of time. So you have a set amount of money out there is determined by the Fed, and they will set it to manipulate the interest rates as opposed to the other way around. Okay? So vertical line there, and wherever the two intersect with each other, that will indicate that's completely gone. We need markers. There we are. Wherever the two intersect, that indicates the current interest rate. Okay, and this roughly corresponds to whatever the federal funds rate is going to be. Okay. So federal funds rate, FFR, that is the interest rate at which banks borrow from each other overnight. Okay. Now, if the Fed is doing expansionary monetary policy, it's easy to remember. Expansionary monetary policy means it's expanding the money supply. Okay, it's going to make the money supply larger. Okay, so expansionary, expand, money supply is going to get bigger. So that would mean that the money supply will shift to the left. When the money supply shifts to the left, what we see is interest rates fall. And again, when interest rates fall, what do people want to do? Spend more. All right? Now, lower interest rates, people are more likely to spend instead of save. Not only that, but at lower interest rates, it's easier to take out loans also. Okay, it's cheaper to take out loans. So we can say people will buy more interest-sensitive consumer expenditures, right? Which is a fancy way of saying things that we borrow money to buy. So people a lot of times might borrow money to buy appliances or furniture or cars or something like that, right? So the interest rate on a loan has gone from, say, 7% down to 3%, well, you're much more likely to take out a loan at 3% than what you were at the higher interest rate, okay? So interest rates fall. Consumers will spend more. Businesses will also invest more, okay? Remember, from a business perspective, they invest, which is going to be spending on capital, or they can save, okay? So at lower interest rates, it's easier for them to borrow money also. But not only that, but investing in capital is more likely to have a higher rate of return than if they save the money, okay? So let's say if they saved the money, it was going to get 7%, and if they built the factory, it was going to get 5%. Interest rates fall. Now if they save the money, they'll get 2%. But if they build the factory, they're still going to get the 5%. All right, well, the 5% on investment in the capital and building the factory is a lot more attractive now. They're more likely to invest. So at lower interest rates, what we see then is that consumption will go up, investment will go up, and therefore aggregate demand will go up, and it will shift back to the right. And we'll get back to where we originally were at the original long-run equilibrium. Okay? So AD will shift back to the right, be back at the original long-run equilibrium before the recession. Okay? Now, when the Fed is doing this, by the way, it's expansionary monetary policy. Well, how is it getting the money supply larger? This is where we see, well, the old joke is the Fed could just print off a bunch of money and drop it out of helicopters, and that would serve the purpose, right? Get the money out there into circulation. But that'd be a really inefficient way of doing it, okay? Be awesome, but inefficient. So the Fed has better ways of going about it, or at least they did before things changed. But again, we won't get into that stuff. But this is where you have the three tools over here, all right, of the discount rate, the reserve requirement, and open market operations. So the discount rate is the interest rate at which banks borrow from the Fed. Okay. The reserve requirement is when banks have to keep a certain percentage of money on hand. And then you have open market operations, which is when the Fed will go out onto the bond market and buy and sell U.S. government bonds. Okay, we've talked about this in the past. A bond is a way for a government or a company to be able to borrow money. Okay, so if the government sells a bond, it is borrowing money from whoever buys the bond. Okay, so it used to be actual physical pieces of paper. Lots of things are digital now. But those bonds can be sold on the bond market. Okay, so if I bought a bond from the U.S. federal government, which I can, go to treasurydirect.gov, right? If I buy a bond from the government, I've loaned the government money, and now it owes me for that bond, right? I don't want to get into the interest and all that stuff, but it owes me money now. Okay, now I'm holding on to that bond. If I want to, I can go onto the bond market and sell that bond to somebody else. Okay. So this is what the Fed will do, is go out there and buy bonds on the bond market. And how all this stuff operates, you got this required reserve ratio. That's what the RRR is, required reserve ratio. Now, you remember that when you deposit money into a bank, what does the bank do with that money that you've deposited?
Spend.
It loans it out, right? It doesn't just blow it, right? That'd be embezzlement. What it does is it loans that money out, right? A bank is a financial intermediary. It's the connection between savers and borrowers. You save your money in the bank, and the bank will then loan that out to somebody who needs to borrow money, all right? Because if you save your money, what do you want your money to do? You want it to make more money, right? And there's somebody who needs to borrow that money, all right? And how do you find each other? Well, if you don't have a bank, that becomes complicated, right? So you don't have to worry about it. You put your money into the bank, and the bank will find the people who want to borrow it, right, and then loan that money out at interest, and you'll get a little cut of the action. Okay. Now, banks, at least previously, were not allowed to loan out all the money that was on deposit. They had to keep a certain percentage on hand. Okay, and this is the reserve requirement, and the purpose behind this is, if the bank has money sitting around, it's not doing it any good. It wants to loan as much of that out as possible. Okay, depending on the bank and who's running it, they may even loan too much out, right, and not keep enough on hand. So there's a regulatory requirement that the Fed has, or had, that required them to keep a certain percentage of the deposited money on hand as either vault cash, so physical cash kept in its vaults or at the vaults of the Fed, or in the accounts that the bank has at the Fed. All right? So it had to keep this on hand, couldn't loan it out. This is the reserve requirement. Okay? And the reason this becomes important is because when banks loan out money, they create brand new money in the economy. All right? So this is the scenario we had talked about at one point. So let's say we got deposits. So people depositing money into a bank. You have the required reserve ratio, the actual percentage that has to be kept on hand. You have required reserve, so the amount of money that is kept on hand. Excess reserves, which is money that can be loaned out but has not yet been loaned out. Then you have the loans. So let's say that somebody comes along and deposits $1,000 into their bank account. Okay? And let's say that the reserve requirement is 10%. So that means that of all the money that is deposited at that bank, it has to keep on hand 10% of that money, and it cannot loan it out. It has to keep it on hand. Okay? So if the reserve requirement, the required reserve ratio is 10%, and somebody deposits $1,000, that means the bank must keep on hand $100. Cannot loan that money out. Okay? The rest of it becomes excess reserves, which is money that can be loaned out. Okay? So excess reserves, money that can be loaned out but has not yet been loaned out. So somebody comes along and borrows that $900, so the $900 in excess reserves turns into $900 in loans. This $900 in loans is brand new money in the money supply that did not exist before. I know, this sounds bizarre. It's called fractional reserve banking, but this is the way that it works. The $900 is real. Somebody borrowed that money and is able to go out and spend it. The $1,000, though, is still showing in your bank account. You can go off and withdraw that if you want to. Okay? So the $900 is real, the $1,000 is real, even though we just created this out of that. Okay? So the $900, somebody borrows that, and they spend it somewhere. Whoever got that money is going to go down to their bank, deposit it in their bank, $900 deposit. You still have the 10% required reserve ratio, which means $90 is kept on hand. Okay, so that leaves you, $810 now? In excess reserves. Okay, somebody comes along and borrows that money, turns into an $810 loan. Another $810 was just created in the economy, in the money supply that didn't exist before. See how this works? Right? And you can keep going, right? So the money gets redeposited, $810, 10% required reserve ratio, $81 in required reserves, which leaves you $729 in excess reserves, which then turns into a $729 loan, blah, blah, blah. Yeah. So what we wind up having here is that each step of the process, more and more money is getting created, but it's less and less at each step. So we're taking that 10% chunk out at each step, right? So this is where we can shorthand it, and we find the money multiplier, right? MM is money multiplier, which is equal to 1 over the required reserve ratio, okay, which in this case is 1 over 10%, or just say 0.1.
1 over the what?
Required reserve ratio, right, which is 1 over 10%, 1 over 0.1. 0.1 goes into 1 10 times, so we have a money multiplier of 10. Okay, we take the money multiplier times the initial excess reserves amount, okay, times the beginning excess reserves, which was $900. That was the beginning of the cycle. So what that means is, by the time the cycle plays its way all the way out to the bitter end, we can create up to 9,000 new dollars in the money supply that did not exist previously. Okay? Now this $9,000 here is a maximum amount that can get created. Okay? It doesn't necessarily mean that it does. Theoretical maximum. The thing is, we're making two assumptions here within this process. The first assumption is that all the excess reserves are getting loaned out. And the second assumption is that all the money that's getting loaned out is being redeposited into the banking system. Okay? So we're assuming both of those. All of the excess reserves is loaned out, all of it is redeposited into the banking system all the way along the line. For whatever reason, if a bank holds on to more excess reserves, doesn't loan it out, or people don't come along and borrow all the excess reserves, then less money will get created than the theoretical maximum. Okay? Let's say that not all of the money loaned out is redeposited in the banking system. Let's say that some people hold on to some of the money as cash in their wallets instead of putting it into their bank accounts. So not all of it would get redeposited, which means, again, we would create less than the theoretical maximum. Okay? Now, I mentioned this because sometimes there are questions where they're testing your ability to understand these two assumptions. Right? The two assumptions is that all the excess reserves are getting loaned out and all the loaned money is getting redeposited in the banking system. If one or two of those assumptions fails to hold, we will create less money than that theoretical maximum amount.
So it's just what you intentionally do with it.
Right. Okay. Now, what this also means, though, is that the Fed can manipulate this required reserve ratio to adjust how much money is getting created in the economy. Okay? If it is doing expansionary monetary policy and wants to expand the money supply, it will lower the required reserve ratio. Because if this percentage is lower, that means that banks have to keep less money on hand, and they can loan out more money, and the more money they loan out, the more money that they will create. All right? Let's say that instead of 10%, it was 5%. Instead of loaning out $900, they can loan out $950. And the money multiplier, instead of being 10, it would be 20. So you'd have 20 times 950, which would be, I don't know what that is, but it's bigger than 9,000. All right? So you would create more money in the money supply by lowering that required reserve ratio, that percentage. With me so far? Okay. Now, if the bank doesn't have enough money to meet that reserve requirement, it has to be able to report by the close of business every single day that it has met the reserve requirement. If it can't, then it will borrow money from other banks. And it will borrow money from other banks at the federal funds rate. Okay, the federal funds rate is the interest rate at which banks borrow money from other banks overnight. So they borrow at the federal funds rate and pay it back the next morning. The Fed funds rate is a market set rate. It's a matter of supply and demand. How much money is available to be loaned out to other banks versus the demand for money to borrow from other banks. Okay, but the Federal Reserve manipulates the federal funds rate. Okay, so it keeps it within about a quarter point range. Okay, but that reserve requirement, the federal funds rate, the interest rate which banks borrow from each other, if they can't be able to borrow it from other banks, they can borrow from the Fed at the discount rate. The discount rate is the interest rate at which banks borrow from the Federal Reserve. Okay, the discount rate is almost always higher than what the Fed funds rate is. Okay, banks don't want to borrow from the Fed because the Fed is the lender of last resort. If you're borrowing from the lender of last resort, that means that other earlier, more preferable resorts were not lending to you. Okay, which means that customers and clients and investors are going to start asking questions about why it is you had to borrow from the lender of last resort instead of from other people or other banks. But the Fed will lower that discount rate in order to encourage the creation of money. All right, lower discount rate means it's easier to borrow from the Fed, which means more excess reserves build up at banks, which means they can loan out more. And then this open market operation, the buying of bonds. The way that works is the Fed can create money, all right? This is what the Fed does. So it will go on to the bond market and it will buy bonds from the public, right? Lots of times from banks. It's a little bit more complicated. You talk about primary dealers and stuff like that. We're just going to simplify it. Let's say the Fed buys bonds from banks. So banks are holding on to these investments, these bonds, U.S. government debt. All right, so somebody at one point or another had bought a bond from the government, right, which means they loaned the government money, and now the government owes money on these bonds. So the bank is holding on to these financial assets, the bonds, and the Federal Reserve will come along and buy these bonds from the banks, okay? So it bought the bonds from the banks, and it paid for those bonds with money. Where did the money come from? Nowhere. It created it, okay? They can do that. They're the Fed. Okay, it's not too much more complicated than they just go to the bank accounts those banks have with the Fed and they just added some money in there, right? Boom, extra money, and all of that money becomes excess reserves, okay? So the money is now out there in circulation. All right, the bank has excess reserves, and what can the bank do with excess reserves?
Load it out.
Loan it out, and it goes through this cycle again, which we'll come back to. Okay, so that's buying bonds, right? The Fed will buy bonds, put the money out there. Okay, easy to remember here. Buy bonds, bigger, right? The money supply becomes bigger when the Fed buys bonds, right? Remember, buy bigger, buy bigger. Okay, the Fed is buying bonds, money supply becomes bigger. Okay, and when the money supply becomes bigger, interest rates fall, consumers spend more, and businesses invest more, all right? And aggregate demand will shift back to the right. Okay? Now, let's say that the government has done its job a little bit too well, and so has the Fed. Let's say that aggregate demand is shifting way out here. Okay? So what's the problem we have now?
You need to contract it.
Huh?
You probably need to contract it.
Yeah, really need to retract it. All right, now we're experiencing inflation. Okay, price levels are rising. Okay. Output has gone past full employment. So we're trying to produce out here, right? But we're past full employment, right? Which means we're already employing most of the folks in the economy that are available to be employed, all right? So we're trying to produce out here, right? And this is what they call too much money chasing too few goods, all right? Because the economy is doing well, people are making lots of money, and what are they doing with all that money? Spending it, all right? So they're trying to spend, but there's not enough stuff to buy, because we can't keep enough production to be able to satisfy all the buying that's taking place. So demand is rising, supply can't keep pace. What's going to happen to prices? Prices are going to go up, right? So this is where we start getting inflation. Okay, so now people are spending too much. So if you're a classical economist, what do?
Nothing.
Nothing. Okay, classical economist is going to look to what to move instead. Well, which line do the classical economists expect to shift eventually?
Demand.
Not demand. SRAS. Okay, remember, classical economists are supply-siders. They're looking for supply to move. Policy guys are going to be demand-siders, right? They're trying to manipulate aggregate demand. Classical economists say, don't do anything, the economy will self-regulate, eventually SRAS will move, right? So they will argue that in the long run, the economy will adjust to the inflation and will shift to the left, okay? Because here, remember, prices and wages are sticky in the short run, but they become flexible in the long run. In the short run, the inflation, if I'm an employer, is actually good for me. I'm selling my goods for higher prices. Nominal wages have stayed the same. I paid my workers $10 an hour before the inflation. I'm still paying them $10 an hour. But because of the inflation, what's happened to the value of that money?
It's going down.
It's going down, right? The money isn't worth as much. How do my employees like that?
They hate it.
They hate it, right? They want some raises because of the inflation, right? I'm good with not paying them more, right? Because I'm making more money that way, right? So nominal wages stayed the same. Real wages for them went down because the value of the money went down due to the inflation. But I can't stay there, right? Eventually, nominal wages are going to go up. Because we're past full employment, I can't find enough workers as it is. So what do I need to do to keep my current workers?
Give them more money.
I got to pay them more, right? So if I want to keep my current workers from leaving me for somebody else, I got to pay them more money. And if I want to attract new workers from the ranks of the unemployed or from other companies, I got to pay more, all right? And my supplier is going to come along and start demanding more money also, right? So contracts will expire, labor unions threaten to go on strike unless I renegotiate, right? So nominal wages will increase. I, as the producer, start making less profit, so therefore I produce less, and SRAS would shift to the left. Right, I'm not going to draw the full line, but it will shift to the left, and we get back to long-run equilibrium again. Okay, again, that would be classical economists. Okay, the demand-siders, though, the Keynesian types, are going to say, no, we can do something right now. And they'll look at this as a spending problem. They say the people are spending too much. What do we need them to do?
Spend less.
Spend less, right? So we need to get people to spend less. So we can use our policy action again. So remember, we had fiscal policy, which is done by the government. The two tools of fiscal policy are taxes and spending. Okay, and you remember with expansionary, when they were trying to get people to spend more, you would raise government spending and or lower taxes. But now we're going to do contractionary fiscal policy. Right? We're trying to get people to spend less. Contract spending in the economy instead of expand it, right? Contract spending. So that means, what will the government do to its own spending?
Lower it.
Lower it. Okay? The government spending can only make things worse, so we're going to lower government spending so we're not putting more money out there. And what will it do to taxes?
Raise them.
Raise taxes. Because if you raise taxes, people have less money to spend, therefore they spend less. Okay? So by lowering government spending and or raising taxes, we can contract, right, the spending that is taking place, consumption and investment. So this is what fiscal policy will do. And then you have contractionary monetary policy.
But then that doesn't actually end up happening, and they end up contracting.
There are political problems, right, when it comes to fiscal policy. All right,
That's why it's more of a theory.
huh?
That's why it's more of a theory
Right,
than
that in actual practice, this is easy to do, especially during bad times. That often doesn't happen. Lots of times that they might be, government might want to start taxing more, right, because they want to pay for this, right? And then during the good times, instead of lowering government spending, they'll actually start to spend more because, hey, we're bringing in all this tax revenue, let's blow it. And a lot of times they'll lower taxes during good times because, hey, if we're bringing in all this extra money, we don't need it all, right? Let's let people keep some of it. Right, so yeah, in actual practice, this doesn't always happen the way that it should. All right, the theory says, but we're not worried about that necessarily. Right, we're just going to say this, what the theory is. Okay. Now over here on the monetary policy side, right, the Fed is going to do contractionary monetary policy, which means doing what to the money supply?
getting rid of it.
Yeah, lowering it, right? So again, go with it. Contractionary monetary policy, contracting the money supply, making it smaller. Okay? Because if we contract the money supply, what does it do to interest rates?
Raise
Just gonna,
probably.
we make the money supply smaller, so it shifts to the left.
Raise interest rates.
Yeah, interest rates rise. Okay? So you lower the amount of money out there, interest rates are going to go up. And when interest rates go up, what do people do?
Spend less.
Spend less. All right? Higher interest rates means that people are more likely to save their money instead of spend it, and they're less likely to take out loans. Okay? Because loans are now more expensive. So interest-sensitive consumer expenditure spending will drop. Okay? And businesses will also invest less. Okay? Which means they will invest in less capital, right? Build fewer factories, buy fewer machines and whatnot. And they will be more likely to save their money instead. For the same reasons, right? More profitable to save money instead of investing it in stuff, and loans are now more expensive. Okay, so interest rates rise when you see a lower money supply. And in order to accomplish that lower money supply, instead of lowering the discount rate, they'll raise the discount rate. If it's more expensive to borrow money from the Fed, fewer excess reserves will build up at banks, which means they have less money to loan out. They will create less. They will raise the required reserve ratio, right? If that required reserve ratio is now higher, banks cannot loan out as much money. If they cannot loan out as much, they cannot create as much money. Okay, not only about that, but the multiplier will be smaller as well, all right? Think about it, or I erased it, but think about it in our scenario there. Let's say instead of the reserve requirement being 10%, it was now 20%, right? That means in that $1,000 deposit, before at 10%, they can loan out $900. Now they can only loan out $800 when it's 20%. instead of the multiplier being 10, the multiplier would be 5, right? 1 over the required reserve ratio, so it'd be 1 over 0.05. Oh, excuse me, 1 over 0.2, which will give you a multiplier of 5, right? So that'd be 5 times 800, so only $4,000 would get created from the $1,000 deposit instead of $9,000. Right? So we'll raise the required reserve ratio and then sell bonds. Right? So the Federal Reserve is holding on to those bonds. It owns them. It's on the balance sheet. Right? It sells those bonds to the banks. When banks buy them, they pay the Fed money in order to buy them. So now those excess reserves are gone from the banks. Now the Fed has the money, and the Fed just gets rid of it. Right? Poof, it's gone. They can do that. They're the Fed. Right? It seems weird, but if you print money, it came from nothing. You can burn money, it went nowhere. Right? The Fed is doing pretty much the exact same thing with open market operations, just in a much more efficient manner, and it amounts totaling billions of dollars in transactions. Okay? So again, easy to remember, sell smaller. Right? Money supply bigger, buy bonds. Money supply smaller, sell bonds. Buy bigger, sell smaller. Buy bigger, sell smaller. Money supply bigger, buy. Money supply smaller, sell. From the Fed's perspective, Fed will buy to make it bigger, sell to make it smaller. Okay? With open market operations being the primary method by which it manipulates the money supply. We're used to. Okay? This makes sense? Okay. Okay, stop that thing. Let's take a break.